Hello everyone and welcome back to the channel. Today we have a fascinating deep dive into Applied Digital, ticker symbol APLD, as we review their fiscal Q3 2026 earnings report and operational update. This is a critical inflection point for the company, marked by a massive 139% revenue surge and major developments in their HPC hosting pipeline. We'll unpack their capital structure, their hyperscaler partnerships, and what their multi-gigawatt pipeline means for their $1 billion NOI target. Before we jump in, please hit that like button and subscribe for more deep dives into the infrastructure powering the AI revolution. Let's get started. Applied Digital has just released its results for the third quarter of fiscal 2026, and the headline numbers point to a company experiencing a massive revenue inflection point. Q3 revenue came in at $126.6 million, representing a staggering 139% increase year over year. This explosive growth is the direct result of the company bringing its new high-performance computing, or HPC, infrastructure online. Beyond top-line growth, the company is proving the fundamental profitability of its core model, generating $44.1 million in Adjusted EBITDA and an adjusted net income of $33.2 million. Crucially, Applied Digital ended the quarter with a fortress balance sheet, boasting $2.1 billion in cash on hand. This massive cash position is essential as the company is engaged in a highly capital-intensive build-out of next-generation data centers designed specifically for AI and hyperscaler workloads. These results set a very bullish tone, indicating that Applied Digital is successfully executing its pivot from a Bitcoin mining host to a premier provider of purpose-built infrastructure for the world's most demanding AI applications. Diving deeper into the financial highlights, the scale of Applied Digital's transformation becomes even clearer. While GAAP revenue was $126.6 million, the company reported an adjusted non-GAAP revenue of $108.6 million, which crucially excludes their cloud services business. Despite a GAAP net loss of $100.9 million, the adjusted non-GAAP net income was a positive $33.2 million, or 9 cents per diluted share. This is a very important distinction for investors to understand. The GAAP loss includes massive non-cash charges and one-time items, whereas the adjusted metrics show that the core hosting business is highly profitable. We see this in the Adjusted EBITDA of $44.1 million, up drastically from just $6.3 million in the same quarter last year, and an adjusted operating income of $25.6 million, which translates to a very healthy 24% operating margin. Furthermore, total assets have surged to $6.2 billion, up an incredible 234% since May of 2025. This massive asset growth, supported by the $2.1 billion liquidity position, highlights the sheer velocity at which Applied Digital is deploying capital to build out its infrastructure footprint. This is a company in hyper-growth mode, building the physical foundation for the AI economy. The segment revenue breakdown is where we see the true driver of this 139% growth: the high-performance computing, or HPC, hosting division. This segment generated $71 million in revenue this quarter, compared to zero in the prior year. This is entirely new revenue stemming from the first full quarter of 100 megawatt operations at their Polaris Forge 1 facility. This is the inflection point analysts have been waiting for. Proof that Applied Digital can successfully construct, commission, and generate revenue from massive AI-focused data centers. Meanwhile, their legacy data center hosting business, which primarily serves Bitcoin miners, remains a steady cash cow, generating $37.5 million, up 7% year over year, while operating at its full 286 megawatt capacity. The cloud services segment brought in $18.1 million. Though it is important to note this segment is being excluded from non-GAAP metrics due to a pending business combination. The story here is clear. The traditional crypto hosting business provides a stable foundation, while the new HPC hosting business is acting as a massive growth engine, propelling total GAAP revenue to $126.6 million. Applied Digital is successfully scaling its most lucrative and strategically important business line. Understanding Applied Digital's true profitability requires a close look at the bridge from GAAP net loss to Adjusted EBITDA. The company starts with a GAAP net loss of $70.6 million. However, the first major adjustment is adding back a $52.2 million loss associated with the cloud services division, which is being separated. Next, they add back $48.9 million in stock-based compensation, which is a massive non-cash expense. Traditional depreciation and amortization add back another $18.5 million. Finally, after adjusting for $9.8 million in one-time legal and acquisition costs and removing a $12.7 million non-cash gain from derivatives, we arrive at the core profitability metric, an adjusted EBITDA of $44.1 million. This represents a staggering 604% increase year over year. This bridge is critical for institutional investors. It strips away the noise of non-cash accounting charges, one-time items, and the soon-to-be spun-off cloud division, revealing that the underlying operations, building and leasing data centers, are generating robust, high-margin cash flow. With an adjusted operating margin of 24%, Applied Digital is proving that its core business model is not just scalable, but highly lucrative once the initial capital expenditure is deployed. Let's zoom in on the star of the quarter, the HPC hosting business. This segment generated a total of $71 million in revenue, entirely from the newly operational 100 megawatt Polaris Forge 1 facility in Ellendale, North Dakota. What makes this revenue so attractive to investors is its composition. The largest chunk, 62% or $44.1 million, comes from base rent. This is high-quality, recurring lease revenue backed by long-term contracts with investment-grade tenants. This provides incredible visibility and stability to their cash flows. Another 27%, or $18.9 million, comes from fit-out services, which is revenue generated by installing infrastructure specifically tailored to tenant needs. The final 11%, or $8.1 million, is from power pass-throughs and other ancillary streams. The key takeaway here is that Polaris Forge 1 is one of the only 100 megawatt direct-to-chip liquid-cooled data centers fully operational in the world today. This specialized cooling technology is an absolute requirement for the dense, power-hungry GPU clusters used in modern AI training. By successfully bringing this facility online and generating high-margin base rent, Applied Digital has proven its ability to deliver the exact type of infrastructure the AI industry desperately needs. While HPC is the future, we cannot ignore the incredible capital efficiency of the legacy data center hosting business, which primarily serves Bitcoin and crypto mining colocation. This segment is operating at full utilization across 286 megawatts of capacity, split between a 106 megawatt facility in Jamestown and a 180 megawatt facility in Ellendale, North Dakota. For the quarter, this segment generated $37.5 million in revenue, up 7% year over year. What is truly remarkable, however, is the return on assets. This segment produced nearly $14 million in operating profit on just $120 million in net reported assets. This is the highest return on assets of any division within the company, demonstrating exceptional capital efficiency. These facilities are essentially cash cows, churning out steady, high-margin profits that provide a solid financial baseline for the company. While the massive growth and capital expenditure will continue to be directed toward the AI-focused HPC segment, this legacy crypto hosting business remains a vital part of the portfolio, throwing off the cash needed to help support corporate operations while the larger hyperscaler projects are under construction. The true scale of Applied Digital's ambition is visible in their campus construction update. At Polaris Forge 1 in Ellendale, the first 100 megawatt phase is fully operational and recognizing revenue. The second 100 megawatt phase is now fully constructed and operational as well, and a third 150 megawatt phase is under construction, expected online in calendar 2026. This alone is a massive complex, but the larger story is Polaris Forge 2 in Harwood, North Dakota. This is a 200 megawatt hyperscaler campus representing a $3 billion total investment. Crucially, it is backed by a 15-year lease signed with a U.S. investment-grade hyperscaler. Foundations are largely complete and precast erection is underway. Furthermore, they just broke ground on Delta Forge 1 in the southern U.S., a massive 300 megawatt AI factory campus sitting on over 600 acres, with initial operations expected by mid-2027. This construction pipeline shows a company transitioning from building individual data centers to constructing massive, multi-building campuses tailored specifically for the world's largest tech companies. The successful execution of these massive projects, particularly Polaris Forge 2, will define the company's financial profile for the next decade, transforming them into a major player in the global infrastructure landscape. Data centers are ultimately a real estate and power play, and Applied Digital's power pipeline is its most significant competitive advantage. The company currently boasts approximately 1 gigawatt of total grid power capacity across 4 active development sites. This includes the 300 megawatt Delta Forge 1 site, a 250 megawatt site in North Dakota currently in active marketing, a 200 megawatt undisclosed site in negotiations, and another 250 megawatt early stage site. To understand the value of this pipeline, look at the key context provided by management. Hyperscaler capital expenditure has surged from roughly $400 billion to $700 billion annually in just the last 3 months, entirely driven by the AI arms race. Consequently, the demand for power-dense, liquid-cooled data center space vastly exceeds the available supply. Because Applied Digital has already secured these long-term, low-cost power sites, they possess immense pricing power in the current market. Currently, they have only contracted about 1/6 of their long-term power potential. This 1 gigawatt pipeline isn't just a list of future projects. It is a highly valuable, constrained asset in an industry desperate for power, giving Applied Digital a durable, long-term competitive moat against newer entrants. Executing a multi-gigawatt development pipeline requires massive capital, and a look at the balance sheet shows how rapidly Applied Digital is scaling. Comparing May 2025 to February 2026, total assets have exploded from $1.87 billion to $6.25 billion, a 234% increase. This is primarily driven by a massive increase in property and equipment, which grew 141% to $3.01 billion as construction accelerates across their various campuses. To fund this, total debt has increased to $2.69 billion. However, the company's liquidity position is exceptionally strong, with cash and restricted cash surging from just $120 million in May 2025 to $1.93 billion today. This ensures they have the dry powder necessary to fund their near-term construction milestones. Stockholders' equity has also tripled to $1.58 billion. While total liabilities have increased to $3.68 billion, this is expected for a company engaged in debt-funded construction build-outs backed by long-term leases. The balance sheet reflects a company that is successfully raising massive amounts of capital, both debt and equity, and deploying it directly into high-yield, long-term infrastructure assets. It is a highly leveraged but highly visible growth model. The ability to secure institutional-grade financing is critical in this sector, and Applied Digital has executed several major moves recently. The centerpiece is their $2.15 billion senior secured notes issuance, carrying a 6.75% yield due in 2031. These notes, issued at 98% of par, directly fund the massive 200 megawatt Polaris Forge 2 development. They also secured a $100 million DevCo facility with Macquarie Equipment Capital to fund the early stage planning and sourcing for new projects. Crucially, they achieved significant lease enhancements with their partner CoreWeave. By restructuring the leases for ELN02 and ELN03 to include unconditional springing guarantees from the parent company CoreWeave, they secured an investment-grade A3 rating for their refinancing. This enhancement drastically improves the credit quality of the underlying assets. Finally, they raised $900 million in non-controlling interest through their APLD HPC Topco 2 entity to fund further infrastructure development. With total debt at $2.69 billion and total capitalization around $5.26 billion, Applied Digital has proven its ability to tap into sophisticated, diverse capital markets to fund its multi-billion-dollar build-out strategy, securing its position as a major infrastructure player. The partnership with CoreWeave is a cornerstone of Applied Digital's current operational success. Looking at the lease structure for the Polaris Forge complex, we see a deeply integrated relationship. The first 100 megawatt building, ELN01, is fully operational. The second 100 megawatt building, ELN02, is also now fully operational. And crucially, the CoreWeave SPV restructured this lease, backing it with a $50 million letter of credit and an investment-grade A3 refinancing. This is a massive de-risking event for Applied Digital. Furthermore, the 150 megawatt ELN03 facility is under construction, and this lease was also restructured to include unconditional springing guarantees directly from CoreWeave Incorporated. This means the revenue streams from these massive facilities are incredibly secure, backed by a leading AI hyperscaler with deep pockets. Looking beyond CoreWeave, the 200 megawatt Polaris Forge 2 facility is backed by a 15-year lease with a different, undisclosed U.S. investment-grade hyperscaler. These deep partnerships and investment-grade guarantees are what allow Applied Digital to secure billions in debt financing. They aren't building data centers on speculation. They are building them for specific, highly capitalized clients who sign ironclad, long-term leases before construction even finishes. A major strategic shift detailed in this report is the business combination of Applied Digital's Cloud Services division. The company's wholly owned subsidiary, Applied Digital Cloud Corporation, is merging with a public company acquirer, EKSO Bionics, to form a new combined entity named ChronoScale Corp., which will trade under the ticker CHRN. Upon closing expected by the end of Q4 fiscal 2026, Applied Digital will own approximately 97% of this new entity. The strategic rationale here is brilliant. It allows the capital-intensive data center business and the software-focused cloud compute business to scale independently, providing much greater strategic and capital flexibility for both. From an accounting perspective, cloud services is now reclassified into continuing operations, but crucially, it is excluded from Applied Digital's non-GAAP results. This is why the $18.1 million in Q3 cloud revenue and its associated $52.2 million operating loss were backed out of the Adjusted EBITDA figures we discussed earlier. By spinning this division into its own publicly traded entity, Applied Digital is unlocking value for shareholders while cleaning up its own P&L, allowing investors to value the core data center business purely on its own merits. To fully understand the quarter, let's look at the condensed P&L summary. Total revenue surged 139% to $126.6 million. However, the cost of revenues only grew by 48% to $72.8 million. This dynamic is incredibly positive, resulting in gross profit exploding from just $3.8 million last year to $53.8 million this quarter. This shows massive margin expansion as the high revenue HPC facilities come online. SG&A expenses did jump significantly, up 251% to $79.7 million. But it's crucial to note that this includes $39.3 million in accelerated stock-based compensation, a non-cash charge. We also see the $59.7 million loss on held-for-sale assets, which relates directly to the cloud services reclassification we just discussed. This leads to a GAAP operating loss of $85.7 million and a GAAP net loss of $70.6 million. But as we established earlier, once you remove the non-cash compensation and the one-time cloud reclassification losses, the core business generated $44.1 million in positive Adjusted EBITDA. The GAAP P&L is messy due to the rapid structural changes and accounting reclassifications, but the underlying trend, revenue growing vastly faster than the cost of revenues, is the hallmark of a scaling, highly profitable infrastructure business. The cash flow statement for the 9 months ended February 2026 tells the story of a company executing a massive capital deployment strategy. Operating cash used was $42.9 million, which is actually a significant improvement from the $122.3 million used in the prior year as core operations become more profitable. The real story is in the investing cash used, which stands at a massive $1.59 billion. Almost all of this, $1.58 billion, went directly into property and equipment purchases. They are pouring money into concrete, steel, and liquid cooling systems. To fund this $1.6 billion build-out, financing cash provided a massive $3.62 billion. The key sources of this financing include $2.5 billion in long-term debt borrowings, $900 million in non-controlling interest contributions, and $740 million from preferred stock proceeds. This resulted in a net increase in cash of nearly $2 billion for the 9-month period. This cash flow profile is exactly what you expect from a hyper-growth infrastructure company. They are raising billions of dollars from sophisticated capital markets and deploying it as fast as possible into long-term, revenue-generating assets, all while maintaining a massive cash buffer to ensure project completion. In summary, Applied Digital's Q3 report provides 6 key takeaways that define their strategic vision. First, they have hit a massive revenue inflection point, with the first full quarter of 100 megawatt HPC operations driving a 139% top-line surge. Second, the core business is highly profitable, generating $44.1 million in Adjusted EBITDA when excluding the cloud division and one-time items. Third, they are making massive construction progress, with 1 gigawatt in the pipeline and Delta Forge 1 already breaking ground. Fourth, they have successfully secured the bag, raising $2.15 billion in debt financing to fund their flagship Hyperscaler campus. Fifth, they are perfectly positioned to capture the Hyperscaler demand surge, which has seen industry capex estimates jump to $700 billion annually. Because Applied Digital holds low-cost, high-quality power sites, their assets are incredibly valuable. Finally, this all builds toward their ultimate long-term goal, generating over $1 billion in net operating income within 5 years, secured by 15 to 30-year revenue streams from world-class investment-grade tenants. Applied Digital is no longer just a crypto miner. They are building the critical physical backbone of the global AI economy. What are your thoughts on their $1 billion NOI target? Let us know in the comments below. That concludes our deep dive into Applied Digital's Q3 fiscal 2026 earnings. The company is executing a massive capital-intensive pivot, and the early results suggest they are successfully securing the partnerships and financing needed to become a major AI infrastructure player. Thank you so much for watching. If you found this breakdown valuable, please leave a like and subscribe to the channel for more institutional-grade financial analysis. We'll see you in the next video. Happy investing.